Investing can seem complicated, but platforms like StashAway aim to simplify it by building intelligent, diversified portfolios for you. A core part of that is their curated selection of exchange-traded funds, or ETFs. So how exactly does StashAway choose which ETFs to put your money into? It's not a random process, it's a careful, multi-criteria analysis. The first filter is all about quality and reputation. StashAway only considers funds from the most reputable managers in the world, like Vanguard, iShares, and BlackRock. They look for ETFs that are leaders in their respective asset classes, whether that's U.S. equities, emerging market bonds, or gold. They want a fund that truly represents the market segment it's tracking. Next comes the deep dive into the fund's characteristics, with a strong focus on cost efficiency. This includes the ETF's expense ratio, which is the fee you pay to the fund manager. Lower is always better. They also look at factors like tax efficiency and liquidity. A fund needs to be highly liquid and frequently traded so your money is easy to move when their algorithm decides it's time to reoptimize your portfolio. Finally, they assess the fund's tracking error. This is how closely the ETF's performance mirrors the index it's supposed to track. A lower tracking error means a more faithful representation of the asset class. This rigorous selection process ensures that every ETF in a StashAway portfolio is high quality, cost-effective, and provides the best possible representation of its asset class. This curated universe of ETFs is the building block for their proprietary investment strategy, ERAA, which then dynamically adjusts the allocation to these assets based on the current economic climate, keeping your portfolio's risk constant. This means you get a globally diversified portfolio built from the best-in-class, low-cost investment products available. It's their way of making sophisticated, well-researched investing accessible and automatic.